Hello and welcome to episode 24 of the Valuability Podcast, Investment Research Made Easy, Part 1. The Valuability Podcast is for financial advisors, business owners, and anyone interested in financial planning, business, leadership, and personal development. We believe that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. My name is Danforth Fleek, and this week we have two very special guests on the podcast. Elisabetta Basilico and Tommi Johnsen, authors of the book Smarter Investing: How Academic Insights Propel the Savvy Investor. Now, if you are a regular listener to the podcast, you'll probably already notice that we're breaking away from the typical format this week, and there are two reasons for that. The first is that Philip was not able to join me for the interview or for the podcast recording, and so I'm flying solo on both of those. And the second is that even though I like to give Philip a hard time about being the one who strays off topic and talks too much, I am equally guilty of both of those offenses, and so the conversation that I had with Tommi and Elisabetta went longer than we could even fit into two normal episodes. And so this week, I'm going to play about the first half of our conversation, and then next week we'll come back with a regular format, and Philip and I will have the last half of that conversation, and then he and I will wrap up with key learnings from both the book and the conversation. I will just quickly remind you that you can find the Valuability Podcast on Apple Podcasts, Spotify, Stitcher, TuneIn, wherever you find your podcasts, we should be there. We also have a YouTube channel. Search Value-Ability on YouTube to find us there. Or you can find us on our website, value-ability.com. Click on the Episodes tab to find our episode player. Wherever you find us, please like, review, subscribe, and share. If you would like to get in touch with us, reach out to us via email. info@value-ability.com is the best way to get in touch with us. If you'd like to follow us on social media, Twitter, Instagram, Facebook, we've got it all. Go to value-ability.com, click on the Contact Us tab, and all of our social media links are there. Also want to let you know that if you want to get a copy of the book, you can go to Elisabetta and Tommi's blog, academicinsightsoninvesting.com. Again, that's academicinsightsoninvesting.com. And we will also put a link to both their blog and their book on our website, value-ability.com. Click on the Content tab and scroll down to episode 24. We'll put links to both the blog and the book there. And now we're joined by the authors of Smarter Investing: How Academic Insights Propel the Savvy Investor, Elisabetta Basilico and Tommi Johnsen. So why don't we start out with just getting bios of both of you?
Sure, I'll start. I'm Elisabetta. I work at the intersection of academia and the practice in finance, in particularly asset management. Tommi and I have known each other for a long time, 20 years. She was my professor, and I was a student in her portfolio management class, which was focused on quantitative methods applied to portfolio management. Actually, after completing my course of study, we became colleagues. We worked for a while at a local pension fund in Colorado, where she was a consultant and I was a quantitative analyst. After that, I decided to move back to Europe, where I'm from, and started a PhD program in Switzerland. And she was kind enough to support my passion to get through a doctorate, and was an external advisor. So we continued to do research together. And then fast forward to 2-3 years ago, when we decided to join our passion, that starts from research and then tries to turn what's best in research into strategies or solutions or content related to investment world. And so we started a blog. We have a blog, academicinsightsoninvesting.com, where we publish every week a summary of a paper that we think it's important for practitioner to take a look. We try to make it as simple as possible. In fact, one of our main goal in our venture together is to democratize research. And so we have this blog, and now we also do some consulting together. We consult to asset manager or private investors, and we focus on, as I said, on using research to educate the investor about important topics in asset management, or do also regional research.
Excellent. Tommi?
Yeah, so I have been in the quantitative space for most of my career, but I initially started here in Boulder, Colorado, where I got my PhD at the University of Colorado. And I was lucky enough to find an academic job in the area, so I didn't have to leave Boulder, which is a really desirable place to live, at least from my point of view.
Sure.
But I started consulting, which was kind of unusual for an assistant professor. At the time, I'd been an assistant professor for probably 4 or 5 years, and I had an opportunity to build a quantitative strategy at the pension fund that Elisabetta eventually was working for. And I was really got in on the ground floor. There were not many quantitative strategies out there, certainly no products to speak of other than, ETFs, spiders, and so on.
Sure.
And I, it started out as a 3-month consulting job, and I ended up staying there for about 15 years. It was just so fascinating. And we built the strategy. They invested close to $1 billion in it. Ultimately, they ran it for pennies. And I got tons of experience. And so I never really went back full-time in my mind, I guess, to academia, because I love that intersection, again, as Elisabetta mentioned, between theory and practice. And I got an eyeful, working for a pension fund.
Sure.
So that was my story. And here I am.
Awesome. It's super interesting to me. I always struggle with my own reference point, and as much as I realized through the years how stilted my own reference point is, and it always shocks me when it pops up and says, oh, you're seeing something completely through your own lens. And this is a case of that. So I started out in the retail side of the business from 95 through 2000, 2001, and then moved into the wholesale side and was working for an investment management company on the sales side, but we were very closely aligned with our investment management group. And the new chief investment officer brought in a whole bunch of portfolio managers, and many of them had quantitative approaches. And so my lens was, oh, this is just the way this is done. Really before that time frame. So it was about that time frame that it started to enter the actual practical world. Quantitative analysis really started to take hold, was in that late 90s, early 2000s.
No, I think it was, the strategy that Tommi mentioned that we were running at the pension fund, and which she is really the mind behind it, was called, a quantitative strategy. Today, this type of strategies are much, much more popular. And really, it's factor investing, smart beta. So, now they're everywhere, but back then they were very few. And also in universities, I think that the courses that were using this quantitative research method to investing were not as popular. Nowadays, every university, I think, has a financial engineering track.
Right.
And so it's much more popular. Math and statistics are very important. And right now it's much easier to get trained. But back then it was a little more difficult.
Sure. I mean, I knew that it was somewhat the stock picking star before that time frame, but like I said, from my vantage point, it looked like, oh, they're bringing in this process from the rest of the world, so the company that I was at wasn't the most progressive, and so I think my lens was just, oh, we're a little bit behind the times, and maybe they're 10, 20 years behind things, but in reality, it was quite progressive. So very interesting.
Well, I think the quant stuff came out of the research, again, from academia about efficient markets and, holding the market portfolio and so on. And then we had the pioneers, Bogle and Vanguard and so on, offering index funds. And then it traveled on into the framework of building in what I would call the anomalies, value strategies, momentum strategies, et cetera, et cetera. And the Quant World was, the perfect place to do that. From my point of view, my training, I had a minor field in econometrics, and I only did that because I wanted to get published, which we'll talk a little bit about later. But it turns out it had tons of practical applications, in the real world. So it was a fortunate event, I think, for me. I was in the middle of all of these things coming together.
Interesting to me. I always think of the investment management side of our industry as light years ahead of just us, us retail guys slogging around in the mud. But in fact, they're a lot closer in terms of the progression of the kind of the more quantitative approaches to things. So that's super interesting. Super interesting. So did the book kind of come out of writing the blog? Is that really where the process started for putting it together as a book?
Yeah, exactly. We realized that we had something that was worth pursuing in terms of writing a book where we try to fulfill this mission of democratizing research. So, and also because there are so many papers that are published every year, every quarter, every month, and it's really hard for the practitioner to stay on top of everything. And so what we thought was missing was a compilation of investing ideas that focus though on bringing on the paper that most represent that idea. And so the paper that's most representative, but also that is robust. Because the problem is, there are so many papers, the majority are good paper, there's also research that you have to be careful. In fact, we do have one chapter in the book where we try to go through a checklist of what to look in terms of finding good quality research.
Right.
Yeah, so I would emphasize that the part about the rigor of research is that, not to diss academics or even practitioners that, publish a lot. There's some pitfalls in doing financial research and in the quantitative area, especially because we have so much access to databases, for example, and we have computers and we can all crunch through the numbers and run simulations and test theories, et cetera, that there are some bad practices that have emerged, and those bad practices are not necessarily evident when you read the article, of course. So there's a whole environment, a social environment that is involved with journals and editors and what they're looking for and what they're incentivized to do and what academics are incentivized to do. And so it can produce some problems out there. So it's not all good news.
Sure.
In the sense of quantitative strategies being superior, there you really have to watch out for the quality. And that was one of the other things about the book, was to say, hey, if you want to read, you're an RIA, if you want to read the best article in factor investing, here are 4, and this is one that is the best of the 4, the best of the best. And the reason that it is that it has a strong foundation and it has rigorous empirics behind it. So we're bringing moving our training into more of a curation, where we're looking at these articles and saying, hey, this is a pretty good one. It sort of gets the stamp of approval. Take a look at it if you're interested in indexing, or you're interested in factor investing, as I mentioned, and so on. So that was also the theme of the book, as well as the articles that we do summaries on our website. So
yeah, excellent. I'll just mention the blog again. It's academicinsightsoninvesting.com, and we'll mention also that I will put a link to the both the blog and where you can get the book on our website, value-ability.com/content, and then scroll down to episode 24 and we'll have links to both of those. And the link to the book is also on the front page of your blog as well, obviously. And then I also did I figured out a quick Google search. So if you're driving around and don't have a place to jot notes down, Smarter Investing Academic Insights. If you Google that phrase, the #1 link is the link to the site with your book. So I did a little reverse engineering there, but that's actually your last comment, Tommy, is a great intro into talking about kind of the first chapter in the book, which is, again, fascinating to me. Your first chapter really focuses in on a whole raft of biases that occur in the process of researching in the investment management world. And I'll just list them out really quickly, so those who haven't had a chance to read the book know some of the ones that we're talking about. So data mining, survivorship bias, look ahead bias, originally stated data versus restated data, transaction costs, liquidity, the cost of shorting, and then appropriate risk adjustments were some of the ones that we jotted down. So in that, the one that jumped out at me, obviously because it speaks directly to what you were talking about before, is kind of one of the big pitfalls is data mining. Do you have an example, like a real world example of that, and how it happens or is perpetrated if it is being done consciously?
I don't want to say, I don't want to cast aspersions on academic methods, but let me just go ahead and cast an aspersion. But, it comes about as a function of the environment that academics exist in and what they're incentivized to do. So we have, first of all, academics are incentivized. They want to get tenure. After 6 years, you have worked through the process, you've published. Journals are not interested in publishing articles that don't show significance. Now, why are journals into that? Well, editors are incentivized to get their journals cited. So citations matter to journal editors. And so you don't get cited unless you have significant results. You don't get tenure unless you publish. And so all of these things mix together to promote really a fertile environment for data mining, which I think is the worst sin of all of the things or biases to look at. So what is data mining? Well, data mining comes about because of this social environment. Is it conscious? Probably it is, because you run a study, you get the results, they're not significant. What do you do with it? Well, you take the paper and you drop it in your file drawer. Call it the file drawer problem, it's just full of things. And so you look for significant results. The statistics that are behind significance, though, are assuming that you've gone through a different process, that
Right.
you've the problem, you've developed a hypothesis, you've developed empirical design around it, you've tested it, and boom, there are your results. The T-stats and the significance levels are only appropriate if you've gone through that kind of process. They're not appropriate if you've gone through and said, well, that didn't work. I think I'll rerun it at a different period of time and I'll tweak this variable and I will, so you end up overstating the significance when you do that data mining kind of thing. Now, why are you doing data mining? Well, you want to get published or an academic, you're not going to get tenure, et cetera, et cetera. So data mining is actually the worst problem. And I'd say it's pretty pervasive. You have to really be careful about it. And the reason you have to be careful about it is that you've data mined these results, maybe you show significant results, maybe somebody implements that into a strategy. The probability that it's going to work out a sample is very, very small because you've overstated that probability. So I can't emphasize enough, data mining is something that we really need to get a hold of. And in the last few years, I think it has come to the fore because of quantitative strategies, where combined with the computer potential, the databases that are out there, it's just so easy to do. Is it conscious? Probably.
So is there any particular thing that would leap out at someone if they were looking at a study that would say, not even specifically to the data mining side of things, but anything that might leap out where one of these might be easily noticeable?
Good question. It's hard to, because you're not there, when the researcher is doing this. But one of the things that you should look for, and it relates to some of the other biases, is that has the study tested it in out of sample situations? So across securities. So you've tested it maybe in currencies or bonds or alternatives and not just equities. You've gone beyond the United States. You've tested it in other countries, other developed countries. And that you have a long time period. You have not benefited from sample specific, this was just the period of time that particular strategy would have worked. And so those are the only ways really to know, because you don't really know what's in the researcher's mind, but, have they done a good analysis in terms of the rigor and the robustness? Because if you've data mined it, it's probably not going to work in another country. It's probably not necessarily going to work without good reason, and with bonds and so on. So, but it's a tough one. And that's a really good question.
No, I noticed that in one of the chapters where the article that you were looking at started out looking at it, I think, just in the United States, and then they went across, all different markets throughout the world, and then currencies and commodities, and really tested it across a number of things.
Well, and the other thing that I would say in addition to that is that one of the things that helps mitigate data mining is that you have a good theoretical basis for the study that you're running. That is the beginning of the scientific method. And so having theory, having a story to tell around it that, that makes sense in a risk and return kind of framework is also another hallmark of mitigating data mining.
So of the remaining biases, are there a couple that you would want to highlight and point out to people?
Yeah, I think the next most important one is survivorship bias. And look ahead bias. Those are probably very close, but survivorship bias comes about when you take only into account companies. As you start a study today, you go to the S&P 500 and you get all the companies that are in the S&P 500 today, and that constitutes your universe. You haven't, and you've looked back over time over those companies, and you haven't taken into account all of the companies over the period that you're investigating that have merged or gone bankrupt or whatever the case may be. And so the companies that last or survive are good companies. They generally have good performance metrics, good returns, good ratios, et cetera. And those that drop out are generally not very successful. companies. This was really a problem with the early mutual fund studies, where mutual funds have an internal practice of folding up unsuccessful companies.
I was going to mention that the mutual funds are like, oh, this one doesn't work. We'll just sweep this one in here.
Yeah, so that you need to be careful about the data set that you're using. And there are data sets that have only the survivors in there. I remember way back then using Bloomberg, they're only interested in the current companies. And they weren't really set up to do quant research, in the way that we're discussing. But CompuStat, Standard & Poor's Global, Thomson Reuters, all of these companies that are dominant in the data vending sphere are quite aware of, survivorship bias. And so they have fixed that problem over many years. So they don't really miss much. So one of the questions, how do you tell, what's the red flag? You got to know something about some of the databases and the quality of those databases, and ask the question, how did you deal with survivorship bias?
Right, so are all the major databases now pretty solid in terms of those?
Yeah, I'd say those ones I mentioned. Of course, there may be some out there that you're using that, either it doesn't matter, or they haven't really thought of it. But startups are probably in a tough position. But as you're looking at databases to use, one of the first questions to the seller is to say, how did you handle survivorship bias?
Yeah, it reminds me of in my wholesaling side, I dealt mainly with life income annuity products, and the annuity business group always does surveys about how it's a great product, but it always made me chuckle when they would say, 80 to 90% of people say that a life annuity is the best or one of the best financial decisions they ever made. And I would think, well, right, because the people that would say it wasn't are dead. it's always exactly the same thing. Like, well, yeah, of course they're all going to say it's great because they're all 110 and they've been getting income for 60 years. So similar kinds of things that you need to look out for. And in fact, I always had a hard time. We would get those in marketing pieces, and I would say, I know some of my clients would probably be swayed by this, but this is not a sample that means anything, really.
Right. There's upward bias in that,
Right.
Not just mutual fund studies that suffer from this. Anytime you're looking at individual companies, it's an issue. So.
Right.
The other bias that goes along with that is related to the database. So having a quality database is look ahead bias. So when you're investigating a strategy, you want to be able to simulate it in real time, for example. So you want to simulate it historically. And you may, let's say you're rebalancing your product every quarter. You have to recognize that built into that is a lag in information as it comes out into the marketplace. So if you're using the financial reports that companies issue, you have to recognize that if your rebalance date is the end of March or any quarter end, that the data actually isn't available to the market for another couple of months. So you, in your simulation, have to take into account that you're actually you don't have the data available to you unless it's market data on the date that you think you do. And so you may be making decisions based on information in a simulation that you really don't have, because you really are rebalancing on information that has come out in the past two or 3 months later. So again, the data vendors have looked at that. We have what they call point-in-time data bases, and they handle a number of these problems. You can also just investigate again as you look at a study, ask the question, do you have a problem with look-ahead bias? Are you matching when the data is available to when you're rebalancing your strategy. So it's not always obvious in the study.
And one last one that popped out at me, just because it was something I wondered about, is how, and obviously without going into the too far off into the weeds, but how do you adjust for costs? Like, it seems like that would be super specific to the individual investor or the end user.
Yeah, interesting question. Most of the time when these studies are done, they're not targeting the individual transaction costs that might be incurred, but they take an average. So they'll take 2%, something like that. And the reason they do that is because transaction costs are number one an issue. If you have transaction costs of 2% and the excess return is expected to be, 1%, it's just not going to work. So the studies are done to show, number one, that there is an impact. There is an excess return, or there is a return tied to this strategy. And the question is, will the average investor, with the average transaction costs, wipe it out? So they're not really done to look at the individual situation.
Okay.
We do have liquidity issues, like if you're going into other countries where liquidity may be an issue, and generally they deal with that by dealing with companies that have a certain market cap, 100, 200 million. Elisabetta, what would you say?
Yeah, probably.
Like that. So, but yeah, transaction costs are important. Does the anomaly, and you are getting more practically oriented there, does the anomaly or does the strategy survive what it would cost you to trade on average?
Sure. And just kind of wrap up, we'll move on to another chapter, but just to kind of wrap this section up as well, really both sides of it, right? Like again, from my lens, I look at and say, the quantitative side, the academic side, they must be more impartial and aware of these biases than we are. But in the end, we're all human, and we all have them. And the question is being aware of them, right? Like they're going to be there, right? And just like, this is my bias. My bias is looking at and saying, oh, the quantitative people are always, completely free of bias. Like, that's my own lens that I'm looking at from. So, there's two sides of it. I think except from the standpoint of, like you mentioned, when data mining, where you're like, oh, this didn't work. Let's massage it to see if we can't find a paper like that. Obviously, you might. We would look at and say, not a process that we would want to get behind. But other biases, they're just it's the way things exist, and being aware of them is the biggest issue. And then, as you said, when you're looking at any specific study, being aware of why they made those decisions and how it impacts the information that comes out. That is a great place to pause the conversation for this week. We covered the chapter on bias in investment research. Next week, we will cover the 2 chapters on multi-asset investing and women in investment management. The book, it actually has 11 total chapters, and when I was talking to Elisabetta about coming on the podcast, I had to try and pick out a couple that I thought were most interesting. And one of the reasons why the conversation ran so long was that I actually couldn't narrow it down beyond the 4 that we are covering. So I cannot recommend the book highly enough. It is really, really interesting. If you want to get a copy, you can go to Tommi and Elisabetta's blog, academicinsightsoninvesting.com. Again, that's academicinsightsoninvesting.com, and there is a link to how to get the book there. I will also put a link to both the blog and where to find the book on our website, value-ability.com. Click on the content tab and scroll down to episode 24, and both of those links will be there. I know we have a number of CFAs that follow us on Twitter and listen to the podcast, and certainly this book would be right up your alley. But even for normal financial advisors, as I was, I really think you would find it super, super interesting. So definitely go out and get a copy of Tommi and Elisabetta's book. If there is a topic you would like us to cover in an upcoming episode, or if there is a question you would like us to answer on the podcast, reach out to us via email, info@value-ability.com. Again, that's info@value-ability.com. If you'd like to follow us on social media, Twitter, Instagram, Facebook, go to value-ability.com and click on the Contact Us tab, and all of our social media links are there. Wherever you find us, please like, review, subscribe, and share. I know you hear the mantra each and every week, but it really is important. If you can support us, we really appreciate it. Next week, of course, episode 25, Investment Research Made Easy Part 2. As always, thank you for listening. Be sure to join us next week, and remember that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. This is a podcast collaboration, not a peer-reviewed journal or a sponsored publication. We make no representations as to accuracy, completeness, correctness, suitability, or validity of any information in this podcast, and will not be liable for any errors, omissions, or delays in this information, or any losses, injuries, or damages arising from its display or use. All information is provided on an as-is basis. It is the listener's responsibility to verify their own facts. You should be aware of the real risk of loss in following any strategy or investment discussed on this podcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this podcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this podcast. Before acting on information on this podcast, you should consider whether it is suitable for your particular circumstances, and strongly consider seeking advice from your own financial or investment advisor. The views and opinions expressed on this podcast are those of the authors and do not necessarily reflect the official policy or position of any other agency, organization, employer, or company. Assumptions are not reflective of the position of any entity other than the authors, and since we are critically thinking human beings, these views are always subject to change, revision, and rethinking at any time. Please do not hold us to them in perpetuity.